Google stock is up almost 9% because they not only reported earnings, but they also reported a 20-for-1 stock split. Hello everyone, welcome back to the channel. Today I wanted to talk about Google, their earnings, how they did, the growth, and their stock split. If you're new to my channel, welcome. Please consider subscribing and smashing that like button since it really helps the channel out. But let's get started. First of all, we can see that the stock went up massively yesterday after they announced their stock split. It ended up 9.15% at the moment. Right now, it is currently trading at $3,000 per share, which is up 8.85%. 8.85% at the moment at 9:19 a.m. currently. Now, Google parent Alphabet announces 20-for-1 stock split, meaning that if a stock is worth right now $3,000, it would be $150 per share. Obviously, this is going to take place on July 1st, so we will have to wait and see what is the price of the stock on July 1st. But we can see that Google parent Alphabet said its board approved a plan for a 20-for-1 stock split on Tuesday as part of the technology company and the stock went up massively after that. We saw that same thing happening with Apple and Tesla in 2020 when they did a stock split, but I'm going to show you that later on the video. Now, we already know that the shares of Alphabet stock have become more expensive lately at over $2,750 per share, each at the time market closes on Tuesday, meaning yesterday, having doubled its price since May 2020. The lower price would mean that more investors might be able to afford buying entire rather than fractional shares of an advertising company. Because let me explain you something. This split is not going to change the value of the company or their fundamentals or anything. It's just that if you have one share of Google for $3,000, now you will own 20 shares of Google for the same $3,000. It's not like you're going to lose 20 times your money or anything like that. It's not like the company is going to drop 20 times. It's nothing like that. It's just that they will split the shares that you already own. And this, in my opinion, is good in the short term and also in the long term because for the psychology factor of an investor. Because right now, if someone only has $3,000 to invest or start investing in the stock market, they will not put all in a single stock because that is really risky to put all your eggs in one basket. But they would have to invest in fractional shares if they're able to and buy, let's say, 0.3 shares of Google and then buy Apple or Facebook or Fubo TV or whatever, but they're not going to buy one single share of Google. Now that they will be able to buy a whole share of Google for $150 per share or so, it will be way better psychologically speaking, because it is way better to have $1,000 worth of 6 shares of Google than $1,000 worth of 0.34 shares of Google. Same thing happened with Tesla and same thing happened with Apple in 2020. Also, we have to take into consideration that not all brokerages offer fractional shares. Yes, Robinhood has it, Webull has it, Fidelity has it, and maybe Interactive Broker has it, but there are a lot of international brokers or people that do not live in the US that are not able to buy fractional shares and are not able to invest in Google or Amazon because there are $2,000, $3,000, almost $4,000 shares, which obviously is a lot of money for a single share. Now, obviously, in my opinion, this is going to affect the stock in the short term as it has happened before with all the stocks that do a split. For example, if we check Apple here, we can see that they did a 4-for-1 basis split on August 28th. And if we check the stock, we can see that they announced a split around April, if I'm not mistaken, and the stock went up 72%. But right after the split on August 28, 2020, the stock dropped 14% because it normally tends to correct itself after the hype. Same thing happened with Tesla. They also announced a split around May or June, same as Apple, and the stock went up 100 and something percent. But after the split on August 28th, the stock went down 15.80%. With this, I'm not saying that the stock is going to go up, that Google stock is going to go up 30, 40, or 100% after this. I'm just showing you guys what history has taught us in the past with many companies. Same with Nvidia. They mentioned their split on May and we can see that the stock went up 40%. But the split was supposed to be done on July 20th. The thing is that the stock dropped about 12% before the split. So this is not a for sure thing that you will buy today and the stock will go up massively until the day of the split, which is going to be July 1st. No, I would never recommend you guys to invest in this stock only because of the split. I do believe it is going to help the stock in the long term because more people will be able to buy into Google, and also because of the psychology factor that they will be able to hold a single share of Google instead of 0.34 shares of Google, and also because people will be able to buy options at a cheaper price as well. Now, that's it. That is everything about the stock split. If you have any question about it, text me on Instagram, text me on Discord, or down in the description in the comment section. But Alphabet also reported earnings yesterday. Alphabet reports big fourth quarter beat stock bops. We can see that they beat analyst expectations on everything. Earnings per share $30.69 per share in comparison to 27.34. Revenue 75.33 billion in comparison to 72 billion. YouTube advertising was the only one that missed. $8.63 billion versus $8.87 billion. And we already expected these kind of things to happen because we have seen many YouTubers, even myself, talking about how our advertising or their AdSense revenue have been decreasing in the past year. And obviously we are seeing that is affecting Google as well under YouTube advertising revenue, because we have seen how many YouTubers, big YouTubers and small YouTubers like me, that have gotten affected by their revenue. Also, the Google Cloud revenue beat expectation of $5.54 billion versus $5.47 billion, and traffic acquisition costs of $13.43 billion versus $12.84 billion. I have to say that is very impressive that they report a revenue growth of 32%. It is the best one so far in comparison to the other big tech companies, because if we check Apple had a revenue growth of 11%, Microsoft a revenue growth of 20%, which obviously is incredible as well, and Netflix of 19%. But Alphabet of 32% is the best one so far. We will have to wait and see for Facebook today in the afternoon, and Amazon later as well. Now, the results follow a year of outperformance. The stock surged 65% last year, beating all other big tech cap companies and more than tripling gains in the S&P 500. YouTube ad revenue was the only metric that fell short of analyst expectations. The company has been trying to challenge TikTok with a service called Shorts. Alphabet CEO Sundar Pichai said the company has more than 15 billion daily active users globally, which obviously is an incredible number. That metric is unchanged from his last update in July 2021. That is the thing, that they have a lot of competition at the moment with TikTok and other social media, which they have been battling and trying to win this war. But obviously it is affecting their active users. And we can see all that in the views of YouTube videos, on Shorts, and also in AdSense revenue. Now, if we check here, we can see that Google grew 32% in the past quarter, but 41% in the whole year of 2021 in comparison to 2020, which obviously is an excellent growth of 41%. Now, we can see that all of their services have actually grown here, as their Google search and others grew about 35% to $43 billion. YouTube ads, even missing expectations, grew 25%. Google Network grew 26% to $9.3 billion, which the whole Google advertising segment grew 32% to $61.2 billion. Google Other grew 22% to 8.1. Google Service Total grew 31%, and Google Cloud grew 44%, which obviously is nice. The only thing here is that their only profitable business so far is their Google service. As you can see, they had an operating income of $25 billion, almost $26 billion from $69 billion. So they are not profitable in Google Cloud, and they're not profitable in other bets. But obviously, we are not investing in Google only because of their clouds and their other bets. We're investing in them because of their Google advertising and Google services total. So obviously that is a nice growth and nice expectations as well, and nice beating expectations from analysts. Another excellent thing from this company is their balance sheet. They have a total of $139 billion in cash and cash equivalents and marketable securities. That is a lot of money. They can buy many companies with this money. Now they have total current assets of 188 billion and total assets of 359 billion dollars. But just take a look at this. They have total liabilities, not current liabilities, total liabilities of 107.6 billion dollars. They are able to pay all their total liabilities, their long-term liabilities, with only their cash and cash equivalents. This is one of the best balance sheets that we have ever seen. And this is something that every company wants to have because they have enough cash to pay their liabilities, not assets. They have enough cash to pay the liabilities. That is obviously incredible, and that is why this company is massive, because cash is king and they have a lot of cash at the moment. We can see that they have a market cap of $1.8 trillion, not like Apple, but still $1.8 trillion. And I have to say that the growth that they have been having is incredible, the expansion that they have been having is incredible, and their balance sheet is the most beautiful balance sheet that I've ever seen. Because they have no problems, no economic problems at the moment with this company. Almost like the same with all the other FAANG companies, but I don't believe any of them have this amount of cash. We're going to check that with the earnings on Facebook and Amazon, and when we compare all the FAANG companies plus Microsoft on a video on the coming weeks. But I have to say that this is incredible. I have a position in Google on my M1 Finance portfolio, which sooner or later I will transfer those stocks to my Robinhood portfolio. As you guys know, this is an experiment for me. My M1 Finance portfolio is an experiment for me. And sooner or later I will transfer that to Robinhood. But I have to say that this is incredible. I love this company. I'm buying this company. I'm not buying because of the split, I'm buying because of the company. I believe the split will help the stock in the short term and in the long term as well, but I would not recommend you invest in this company just because of the split. Yes, it could help the stock go up 34%, or maybe not. So I would not risk it. But it will obviously help it in the long term because of the psychological factor of that many people will be able to buy way more shares right now than before, and it's also way better to hold 6 shares of Apple than 0.34% shares of Google, sorry. I will leave you here a video of the stocks that I'm looking to buy this month and here for you to subscribe. Thank you and see you next time.